The US stock markets are sinking, led by Apple, as we see the October chaos spill over into November. There are several excuses which the mainstream media have made for today's fall, but the truth is that the underlying cause has yet to be addressed, and that's why the market can't shake this off. We can't even envision a world without trillions of printed dollars being used to buy up US assets and ultra-low interest rates. Just the thought causes the fallout in the markets you have seen. You came here for the truth, so let me unveil that for you. Today we're going to look at what's happening in the stock market. I think it's important to track and trace all the events as they happen on a daily basis, but understanding what's going on behind the scenes. That's really the driving force. So we're going to begin by taking a look at this. Dow plunges 500 points as Apple leads tech rout. In the article, they try to make excuses left and right. It's Alibaba's fault. It's the sun not coming up in the morning. It's clouds. It's weather. It's this and that. Well, I want to look at what's really going on behind the scenes because the Federal Reserve is responsible for what's happening today. They had juiced up this market to a point that made absolutely no sense. Even the bulls were suggesting this is getting a little too heated. And then we had October, which has now spilled out into November. As I mentioned in the introduction, you can see what they have done is created a bubble they cannot control unless they pull back on all of that easy money. And they're trying to do it. They're doing it way too slowly. And still it's giving this market a problem. Nobody wants to acknowledge that all of this cheap and easy money is the reason the stock market has been driven up, and it's the reason why stocks will go down. I addressed in my previous video that the Swiss National Bank, which has been an excellent buyer of US equities, including tech stocks, especially tech stocks, they have actually sold in the third quarter of 2018, coinciding with what we had seen during October, that weakness there prevailing. This, as I recorded in the middle of the day on Monday's trading session. These are the markets. We're going to focus on the top three, the S&P 500, the NASDAQ, and the Dow Jones. You can see that the Dow Jones right now over 450 points down for the day. The NASDAQ is down 2.5%. So when we look at these markets, we need to look at where they have been, not just in the last 24 hours, but of course we want to see where they've been for the rest of this year, for the last 3 months and so on. This gives us a trend. This gives us an idea of what we can expect for the next few months, for the next few quarters here, as we can look at whether it's strength, whether it's weakness that is prevailing. You will see here that I'm looking at the S&P 500 on this chart, but you can forward through, see the NASDAQ, see the Dow Jones, look at it year to date as an example. It's been highly volatile throughout 2018, and it's been essentially erasing most of the gains that we've seen all this year. We're basically at the end of the year now. We're in November, and yet we have not been able to progress. That shows this weakness in the markets today in the United States, but it's no different than what we have seen in other markets around the world, whether it's emerging markets, whether it's some other European markets perhaps. They're not looking good. There's no other way to put it. This happens to be the Dow Jones. As I record it, it's down 459 points, and you'll see that when we look at the 5-day, it had come up quite a bit here last week, and you'll see that. And then it started to decline through Friday and continued that into Monday, okay? So we're looking at the statistics just to give us an idea of where we can expect this to go. Then I want to get into GE. Now, GE is obviously a massive corporation, one of the biggest companies in the world at one point, and has now been just facing a terrible, terrible year, one of its worst declines it has experienced since the financial crisis right now. And I think it's actually going to need a bailout. General Electric's chairman and CEO Larry Culp said on Monday that he feels the urgency to reduce the company's leverage and will do so through asset sales. We have no higher priority right now than bringing those leverage levels down. GE shares fell 7% on Monday, slipping below $8 a share for the first time since March of 2009. I'm going to show you the chart in just a second. The stock fell as low as $7.72. This has been just beaten up over the years, and you can see what has happened on the daily chart. Currently down about 6% as I record this. If you look at the 5-day, if you look at the 1 month, if you look at the 6 month, if you look at the year to date, I mean, it's just bad, and worse. All right, now I'm going to show you a chart that goes further back into this. By the way, the market cap is $70 billion. Now, while $70 billion is still big, it's not as big as it was at one point, not that long ago. We have to remember where this was a few years ago, and it is technically a very important company that makes a whole bunch of different products. And then they even had their financial side, GE Capital. They had all different types of avenues that they were able to get a strong foothold in. Things have changed, and you can see that this company is probably going to need a bailout. It's going to be nationalized. It's going to be taken over by another institution. I don't know exactly what's going to occur, but certainly we can see that it's not looking good for GE and the shareholders of this particular stock. Now, this is actually a little bit outdated on the chart because we've actually dipped below this, and it has appeared to go below the $8 mark, so it's gone further down. The last time we experienced this, other than this blip that appeared in 2009, was 1995. My goodness, it has fallen so unbelievably far. Throughout the 90s, this stock rocketed higher. Of course, along with everything else, it did take a big swing downward. Then with all of the other housing and financials and tech and everything else, it started to increase, but we had the financial crisis. But once again, it was able to recover, hitting about $30-something per share a couple years ago. But it has fallen off a cliff and doesn't seem to be able to recover. And I think that we could experience a bailout. We might hear about that, so I will definitely cover it for you. Moving on, a record number of assets in the U.S. have a negative total return year to date, 89%. That's a record. This information comes out of Deutsche Bank, Bloomberg Finance, and so on. But you can see that as of October 31st, we haven't seen this ever. I don't know how they're coming across this calculation, but that is absolute insanity. Because when you look around the world, where is the strength? Where was the strength in October? What markets have done very well in 2018? It's a very, very short list. And that tells us that we've got something coming. It's coming around the corner. When? You tell me. Then we bring this all around to finish off the video. And I think this is absolutely critical. You're not going to get this type of information connecting the dots to the previous. So you always need to address this for yourself and what it really means. When you look at a stock, when you look at what's happening in the economy, what does that mean for the average individual? After years of low prices fed by near zero interest rates in a convalescing economy, Americans are waking up to costlier consumer living. Now, first of all, when I read that, I started to think to myself, are they using the ridiculous CPI measure? Perhaps, but I continued on. Everyday household staples like diapers, toothpaste, shampoo, and dishwashing liquid, not to mention soft drinks, cookies, chocolate, cat litter, autos, they've all started getting more expensive, a trend expected to continue into early next year. Announced by companies during the most recent earnings season, these price hikes have typically ranged from 2% to 10%. They also stand in stark contrast to the unusually unending sales and promotions of major retailers like Walmart and Amazon. Look around, find something that's regular price, and you will not see a lineup. You will not see any interest. It always has to have some sort of rollback, discount tag, sale price, or else people aren't going to buy it. This goes on to talk about what's happening with the tariffs is making things more expensive. They're considering the fact that there is mounting transportation costs. Now, if they're talking about this because of the tariffs, maybe you could say maybe in some cases that it does affect it. It doesn't matter what's happening here when you look at the direct impact of this on the individual when we consider tariffs, when we consider taxation, when we look at this. It doesn't really matter to an average person. They want to know what they're paying at the store. How much does my toothpaste cost? If I'm buying the same brand, I'm going to go to the cheapest place to find it. I'm going to try to get that. If I can't get that, I'll get the no-name brand. If I can't get that, I'll get something else that will make it so that I can buy what I need to for my family. That's what it comes down to. The core message is I earn money at my 9-to-5 job. I go to the store to buy the food that I need for my family. If that's too expensive, I search for alternates. Then if there's no alternates, that increases my price that I'm paying. It takes away from my disposable income. If I have no disposable income left, I then go to debt. I use my credit cards. I use my mortgages, double mortgage, reverse mortgage, all kinds of fancy names that they have for debt. I go into debt. When the debt eventually has a problem, like we saw in 2008, it collapses not only the corporations, not only the nations, but the individual as well. That's where we're at today. I hope you found this video informative. If you did, please give me a thumbs up. When you give me a thumbs up, you are supporting this channel. And don't forget to hit that subscribe button as well. I really do appreciate that. Last but not least, if you found the video informative, then my 2 books, you'll find them even more informative, okay? Because I get into everything and I've removed all of the jargon, all of that financial nonsense that they use to make themselves seem oh so smart. I got rid of it all. Anything that needs to be discussed, I put at the very beginning of the book in a sort of little beginning section. Gives you all the terms you need, all the individuals you'll need to know, but there's a very short list anyway, because I got rid of all that. You don't need to understand all the ins and outs of a derivative and the complex formula. You just need to know what it is and how that affects you as an individual, and that's what I've done. Check out the 2 books. Link is in the description. If you're more interested in the audiobook version, you can get that at themoneygps.com.